How can the funds from a reverse mortgage line of credit grow over time? A traditional home equity line of credit we're used to, you have to pay back, you have to make payments, and it expires in 10 years. So this is very different, and it's actually the single best feature of the home equity conversion mortgage or HECM line of credit. Stick with me for a couple minutes and I'll show you exactly how it works. Here's where we're headed. I want you to see this as that this isn't one rigid product. It's one line of credit that can be used 3 different ways, and you can change in the middle, depending on what your retirement needs might be. You can let it grow as a safety net, and it just gets stronger every year. You can put it to work and draw what you need or want today with no monthly mortgage payment. Or you can pay it down, cover the interest. If you took a draw up front, you can pay it down, cover the interest, and even more of that becomes growth as the available line of credit. Same loan, 3 strategies. Let me walk you through each one so you can actually see how it works. It starts with the principal limit. Think of this as your total borrowing capacity, and it's set by just 3 things: the value of the property, the age of the youngest borrower, and the prevailing interest rate. Once it's set, it's guaranteed to grow every single year automatically. And that growth is not tied to your home going up in value. It keeps growing even if the housing market sits completely flat. It's contractual and guaranteed by FHA. So let's put real numbers to it. Picture a borrower who's 70 years old with a home worth $1,250,000, and we'll use today's expected rate of about 7 1/8. Now let's look at 3 different ways that very same loan can play out, starting with a client who opens the line of credit and never takes a draw. See, everything starts with your home value. HUD uses the formula that considers your home value, the age of the youngest borrower, current interest rates, and the reverse mortgage program you select. The result is called your initial principal limit. We've covered that. Think of this as your starting borrowing capacity. In this example, the home is worth $1.25 million, and the initial principal limit is about $456,000. That's the amount available to you based on the formula set. It's an important point. That's your borrowing capacity, not your loan balance. You decide how much, if any, you actually use. So let's see what happens to that borrowing capacity over time. You might be thinking, if I never touch it, what's the point of getting bigger? It's money I'm not using. Well, that's exactly the magic. When you leave it alone, almost all of the growth becomes available credit. That little gold sliver at the bottom is just the finance closing cost. And while it does creep up slightly over the years as interest accrues, it stays tiny next to everything green above it. That green is what you can borrow later, and it keeps stacking up. In this example, you start with about $421,000 of available credit at closing, but by age 85, it's grown to roughly $1.4 million, and it's a standby resource that actually gets bigger the longer you don't need it. Now, the natural pushback is sure, that's only because I didn't borrow anything. What if I take a big chunk out up front, like paying off a mortgage or whatever other need might be? Then it can't grow, right? Not the case. Watch what happens, because both pieces will grow and still grow. The blue is what you borrowed. If you make no payments, the interest gets added onto the balance, so it climbs every year. And look at the green. Your remaining credit or available credit line grows too. Why? Because the whole principal limit is still rising underneath it. Again, guaranteed to happen. So even after an initial draw, say you used it to pay off that small mortgage, you're not frozen. There's still more capacity coming. And here's where people get anxious. Wait, so the balance I owe is going up the whole time? It compounds? Yes, it does. There's no free lunch. Remember, you're not making payments. That's your benefit. If you make no payments, the interest compounds. That's a fair concern. But here's the choice most people don't really even know they have. A HECM lets you pay any amount over time. So there's no required monthly mortgage payment, but you absolutely can pay. And that one choice changes the picture, especially if your current cash flow can comfortably handle a payment, because a payment can actually make that line of credit grow even larger. So there's a resource down the road when you need it most. So what happens if you do pay? If you pay just the interest each month, the balance stops growing. and that stays flat, dead level. Meanwhile, the entire principal limit keeps rising, so nearly all that growth turns into available credit. Same big draw as before, but now the green part climbs past $1 million where the blue holds perfectly still. That's making an interest-only payment. You took the money and you kept your future borrowing power growing. In this example, that'd be about $14,000 a year, roughly $1,176 a month, to hold that balance flat. But look what it does to the available line of credit. It accelerates that green portion that you can still borrow. So let's tie it together. It's the same loan used 3 different ways. Don't draw and your credit compounds for later. Draw and don't pay, the balance grows, but your credit still grows too. Draw and pay the interest and your balance is frozen while your credit grows the most. And the math underneath it is simple. The principal limit is always split 3 ways: what you can still borrow, what you owe, and any amounts reserved. As the principal limit grows, the total of these 3 parts grows with it. Your only job is deciding which part you want to feed. So we're back where we started, but now it should make a lot more sense. Remember these 3 strategies? You've now seen each one in action. Let it grow. The whole line compounds into a safety net that's the biggest right when you might need it most. Put it to work. Draw what you need today. No required payment, and the line still has room to grow. Or pay it down, cover the interest, hold the balance flat, and keep even more of that growth, the credit that you can control. Same loan, 3 strategies, and you can shift between them as life changes. That's the real power of it. Flexible, growing, and ready for whatever retirement brings. If you came in thinking a growing line of credit wasn't possible, I get it. But the growth is built in. It's not a market bet. You control the outcome. It's not one size fits all. It's built around the retirement that you actually want. If you'd like to see what this looks like with your own numbers, reach out. Let's design yours and help your retirement.